So I do a lot of virtual coffees with financial advisors. We have coffee with Chris. And one of the topics that's coming up more and more right now is, how do you talk to your high net worth clients in all of this doom and gloom that everyone's talking about, whether it's inflation, whether it's, volatile stock market, whether it's high interest rates. So today's guest, we're welcoming back Simon Bowers to talk about what should you be talking to your clients about right now. Hi, I'm Chris Reynolds, and I'm on a mission to help independent financial advisors build a better business through a remarkable client experience. In this podcast, you're going to learn how to do that from my conversations with the visionaries, the leaders, the independent advisors who are reshaping the future of the financial advice industry. At the end of each episode, you're going to walk away with an actionable idea that you can take and use right now, and it will help you to build a better business today. This is Turning the Page. Doom and gloom. Everywhere you look in the news, there's so many reasons to worry. And yet there's some serious things going on in parts of the world, and these things can affect anyone. But no matter how much you read about the financial markets and read about the economy, is it really doom and gloom? Have we never seen it before? So today we're talking about the hot button topics in the economy that affect you, affect your clients, and what kind of things you should be talking about with your clients, whether it's something you or they should be worried about it, and how do you talk to them about it. So today joining me is a guest that we've had before. It's a high net worth specialist, and he deals with high net worth clients and has for the last 20 years. We have Simon Bowers. Simon has been with IPC for some time, but he's been 20 years in the investment counseling industry. He's the head of retail trading and the vice president of portfolio management in a very large high net worth shop. He has portfolio responsibilities for our separately managed accounts for our clients, as well as he, runs a lot of things in the fixed income as well. He's really an expert. He's got his CIM. He's got his fellowship of Canadian Securities, certified international wealth management, and as I said, 20 years experience. So I can't wait to talk to Simon about all the things that you should be talking to your clients about right now. Simon, welcome back to the podcast.
Thanks, Chris. It's a lot of fun just to have these conversations, to have a little bit of banter about what's happening in the markets today. I think we can get to a lot of great touch points for advisors and clients.
Well, absolutely. And I've been getting a lot of inquiries by advisors on, this is difficult times. We've never seen it. It's unprecedented, all of those things. But before we get into all those great conversations, just for the audience, again, give us a little bit about your story. I know they might have heard some of it, but it's great to sort of reestablish. How did you get here?
Yeah, so I joined IPC in April of 2022. We were looking to redo the high net worth experience inside the firm. And so I was invited to come join, and it's been really great. We've had a lot of great touches, a lot of opportunity to upmarket the experience and to really deliver that service experience and make it much more client focused and much less about a product that we're trying to sell to a client. We're trying to help advisors and clients get to where clients want to go. And that's informed a lot by the 20 years I did spend at an investment counseling firm, so 2002 to 2022. So grew up in the high net worth business. I can't claim to have seen it all, but I will have seen it most. So we've seen a lot of the problems that we're all trying to solve, and the things that an advisor will see once or twice in their career is something that Lee, the other portfolio manager in our team, and I will have seen many times. So we're happy to do that consulting. Before that worked at a major independent brokerage. Before that, Manulife. And so I said to a client the other day that my capital markets experience goes back to the last century, and here we are in 2023. That's starting to mean something. That's my backstory. Thrilled to be here, really enjoying the IPC experience.
That's excellent. It's great stuff. So, we've talked about this before, as F. Scott Fitzgerald once said, the rich are different from you and me. But you get to deal with people with large sums of money to invest on a very regular basis. And some of, the most successful people in the Canadian marketplace. How are they different, and how are their needs somewhat different than what I'm going to call the retail client?
Yeah, so that, high net worth accounts, people who have made what they're looking to make and are now having their money work for them. they tend to be a little calmer than people who are on that wealth journey. Even though sometimes when you look at the portfolio, if you have, say, a $2 million account with a 3% market movement, that's a car. And so,
Right.
these people have seen this before on their way to having $2 million. And that's really, an important thing to think about wherever you are in that wealth journey, right? Whatever's happening today is something we've seen before. It's happened before. That Mark Twain quote of history may not repeat, but it sure does rhyme. So we've seen a lot of the elements that are in the cake that we're baking today. So high net worth clients tend to be a little calmer because they say, I've seen this before. This is something that we've had before. We've seen 18% inflation in the 1980s. We've seen 5% CPI in the 1990s. We saw higher inflation in the early 2000s. So they're not super worried about that because they've seen it before.
That's a great topic. Let's launch onto that one. Inflation. Inflation. Every news article, every time you turn on the TV, everything. Even if you look at TikTok, they talk about inflation. What do you think of inflation? Where are we today, and how would you put that in context of where we have been in the past?
So I think the first thing we need to sort of set the terms of what inflation is, and inflation is goods are going to cost more tomorrow than they cost today, right? And that's just the simple nature of an expanding economy. So a little bit of inflation's a good thing, right? Inflation's got this very negative connotation, but it's not something that exists outside the system. It's part of the system where the
Right.
Bank of Canada targets between 1% and 3%. So you can say they're targeting a 2% is their absolute target. The Federal Reserve, the European Central Bank, everybody wants a little bit of inflation. And not being able to get inflation going is actually what's cost Japan 2 decades of investment, or 3 decades of investment now,
Very
where
true.
they haven't been able to get things going. Their equity market has not hit the highs that it saw in the 1980s. And so, we've seen lost generations of wealth. A little bit of inflation is a good thing, right? That lets companies raise their margins, pay employees more. So a little bit of it is fine. What we saw in the post-COVID reboot was everybody trying to start all their engines at once. And all of a sudden, we had a clambering for, well, I need microchips, I need raw supplies, I need labor, and so you had everybody fighting for a scarcity of goods. And so that goes back to that supply chain disruption that we saw where everybody was trying to get through the door all at once. And you can't all leave a movie theater at the same time, right? You have to form an orderly line. And that's what drove prices up. And so, we've seen a lot of that come out of the system. It's still in there a little bit. It's embedded. If you look at recent CPI prints for the entire calendar years, we saw 3.4% for 2021, 6.8 in 2022. So those are well above the trend. Those are well above where the Bank of Canada is targeting. And that's why we took rates so high so quick.
Right.
Let's talk about what that means in the context of an average.
Right.
If we average inflation over the last decade, it's 2.2%, and that's including a really high print of 6.8% in 2022. If we look at a 20-year average, it's 2.1%. If we look at a 30-year average, it falls below 2. So we really had a real outlier year, and it was tough to digest for a lot of people, and fair, because there wasn't a safe place to go. You could go to cash, I suppose, but then you would have missed a lot of the rally that happened in June and July of last year. So it's been a really tough environment to invest in because people say, well, inflation's eating my bond returns, stocks are underperforming, where can I go? And this is where, some of the calls that we get with clients, and I'm sure advisors are seeing this, where they're saying, well, I've lost a year of my retirement. I've lost a year of my planning.
Right.
I've lost a year of that. And this is where I think the advisors can do a really great job, because I like to say you've got the first 14 months of a calendar year to make an RSP contribution, right? Everybody seems to want to backload it into February, but when markets are misbehaving, that's a great time to reach out to your clients and say, hey, we've got an averaging in opportunity here that we don't know how long it's going to last for. Could you make half of your contribution here and today, averaging in, and so take advantage of market misbehaviors?
Well, I was also going to say the one thing that we experience a lot is this sort of extrapolation. You see a short-term trend, as we've seen in inflation and some of these other things, and then we extrapolate that's going to happen for the next 20 years. And so they're like, we have to prepare for this, we have to do that. Meanwhile, to your point, really all it is sometimes is a mispricing. And that mispricing gives us an opportunity to take advantage of some great bargains out there.
And some of what we're looking at is a really high inflation number. Some of that is base effects, right? If we're only at 2% for the last 10 years, but we've got a sort of a 7% built into that 20% over 10 years, right? We're building from a low base. So yeah, It's a lot to digest all at once. And I'm not saying everybody should say, well, thank goodness my bananas cost 3 times more than they did, 2 years ago. But we've seen we've seen the tempering here. A lot of what the Bank of Canada and the Fed have been looking to do is working. Consumers have done a lot of the heavy lifting in moving down from their favorite brand to the yellow and black brand. We've seen a lot of consumer behavior where they push out their car one more year than they would hope to. And so, inflation's coming off. Really interesting part of the recent inflation prints. So we saw 4% if you round up, 3.9974. But out of that, 1.3% plus was actually variable rate mortgages and rental replacements. So the Bank of Canada, by taking these rates dramatically higher, are actually 30-35% of the problem that they're trying to solve. And that's how you can have confidence and say, well, this is working. Because variable rate mortgages are only 4% of that basket, of the overall inflation basket. But because they've gone to the moon, we've seen such a dramatic impact on the basket. So once those rates start to come out and variable rate mortgages start to come down and rent replacements for mortgages come down, you actually start to get closer to a 3% and then a little bit of cooling, and we get to a number that the bank is comfortable with.
So if you like what we talked about with Simon and you want to talk about how it would apply to your particular practice, I'm happy to have a virtual coffee with you. In fact, I do these virtual coffees with Chris quite often. So, just go to the show notes, hit the link, and you can schedule a call with me. Happy to talk about what you should be doing and saying to your clients right now.
Well, that's a great extension. So that was a question I was going to ask is, everybody's mind, especially if you live in Toronto, for example, is the housing market. Let's face it, it's expensive, incredibly expensive, especially even on a worldwide basis now. So, what do you think? How is this affecting this? And how do you think about this expense in the housing market?
So, it's anti-inflationary for sure. When your mortgage goes up, that's sort of like a tax, right? And so, you're paying the banks more interest, or however you sourced your mortgage, you're paying more interest to the banks, which is good for the banks, but it's bad for the consumer. The phenomenon where we've seen housing prices hold steady is because so many people have bought their starter homes and they bought them at 1%, 2%, or anywhere in the last 10-year cycle where you could get a really cheap mortgage. And they can't afford to move from that starter home to the next level, the mid-size home or their forever home, because the carrying costs are 3 or 4 times more when you add in the property value plus the interest rate. So you have a lot of sort of shelter-in-place mentality with the real estate market, and that's what's driving the prices. Is if you want to move somebody out of their house, you need to pay a premium because they need to replace that house with other housing. So, we've seen a little bit of people moving out of city centers in, telecommuting and remote work. A lot of people have moved further afield because they say, well, I'll commute 1 or 2 times a week. But that's not enough to sort of remove the phenomenon of, hundreds of thousands of people coming to Canada every year. They want to go into really 4 places, Toronto, Montreal, Calgary, Vancouver. And that's not, not to diminish any of the other great cities in this country, but people want to go into, the large places where there are great jobs, great prospects. And that really puts a lift under all the housing as well. Canada favors economic immigration. And so, some people will arrive from other places with, the $1 million needed to buy a starter home. And that takes some of the supply out of the market as well. So I think really what we're looking for is, as rates come down, and there's every reason to believe that they will, if we look at how the Canada 5-year curve looks, we look at some of the steam coming out of the system, some of the inflation going away, we'll see some lower rates. Does that translate into more affordable housing, or does it just translate into the same cost of housing with an easier mortgage payment? I think in the major centers, it's likely to be the latter, right? You'll just have the same priced house. It'll just be easier to carry on a month-to-month basis rather than, it'll cost you $4,000, not $5,000.
Exactly. Well, that also goes to, talking about debt and talking about interest rates. There's always the concern that we're seeing. And again, every newspaper article that you read is about the US debt ceiling and what they certainly continue to raise it. It continues to get higher. It continues to affect not only their economy, but a worldwide economy. How would you address that as a concern? Because I'm sure that people are thinking about it all the time.
Yeah, it's certainly newsworthy, but newsworthy is decided by the news producers. There are 12 to 15 24-hour news channels now, and 24 hours a day of content to fill. The debt ceiling is one of those things to be mindful of, but I don't think it's something to really worry about. Really, what we're looking at is we've said to somebody, this is as though you've given your kid a credit card and you say, you decide what the credit limit is and you never have to pay back the principal, and you can amortize the interest as principal and pay it back when you feel like it. All you have to do is tell me what the credit limit is.
Right.
And they've reset this. It started at it was born out of 1917, World War I. Congress said, we need to spend on this war effort, but let's not overspend. They've raised it 78 times in the last 100.
Only 78?
Only 78 times.
Very reasonable.
And so you've seen some sort of exponential growth in it. It reached $1 trillion under Reagan, who actually campaigned on the issue of getting debts under control. And now it's over $30 trillion. And so that's it. So where that becomes concerning is now the U.S. is seeing a higher servicing cost. It's now costing about 4% to roll that basket. So $1.2 trillion a year of interest, and so that's about $3.3 billion US a day. So for context, that would let you buy Royal Bank in a month.
Right.
These are and so these are big numbers. And really, they need to find ways to sort of get that under control. There are three mechanisms, three levers that they can pull. The first is the taxes. They can increase their taxes. They can start charging people more. That's not really something that Americans like to hear. Nobody likes to hear, hey, we've got to pay more taxes to get ourselves out of this. But I think that's sort of the logical, reasonable answer is to pay a little bit more in tax on the way through. The second way, and this is more mechanical and fussy, and it's really a funny piece of the U.S. Constitution, is the president is allowed to mint a platinum coin, instruct the Treasury to mint a platinum coin, as long as it's platinum, and it can be any amount. And they can simply put that in the Treasury buys back $1 trillion worth of bonds, and now there's more headroom between there and the debt ceiling. And the last issue, which is fairly obvious, is just do away with the limit. It's completely self-imposed.
Right.
If you have fiat currency, you can print as much money as you want. You can pay your debts in still wet stacks of bills if you choose to. And all of that is fairly glib. It's something to be mindful of. If we had a U.S. default, you would probably see a 4% drop in U.S. GDP, but that's only that doesn't count. What then happens to the knock-on effect of the banks to China to Canada. It's a big impact. You only have to look at what happened in the mortgage market in the U.S. to see what the knock-on effects were.
Right.
And so the U.S. walking away from or being unable to pay their debts is a material thing. I don't think it's a problem here in today, though. The real problem with the debt ceiling, or real problem with U.S. debt, is if China and other foreign countries stop buying those bonds, because the U.S. can effectively borrow as much as people will lend them.
Give them,
and so the real concern there isn't that the U.S. debt stack grows and grows and grows. It's a problem. But the real problem or the real concern would be around Russia and China and, say, India forming a currency compact and creating an alternate reserve currency.
Right.
And that's where you start to see real problems. I think this is a global issue, though, and China is going to be part of the solution. And the reason I'm confident saying that is that the old maxim, if you owe the bank $1,000, that's your problem. If you owe the bank $32 trillion, that's the bank's problem, right?
Exactly.
So
that's your partner.
Yeah. So, It's an enormous number, but it's self-reporting, right? This is they're telling on themselves by saying, "Hey, we're near our credit limit," but it's not actually their credit limit. Their credit limit is really wherever the market will support them borrowing.
Right, and keep going. And you made a good point, and one that, of course, in the minds of Canadians, especially high net worth Canadians, that we're always thinking about, of course, is taxation. And taxation is incredibly high in Canada, and I could go on an entire rant just on taxation in Canada. And the government saying, "Oh, well, it's the grocery store's fault that you can't buy groceries." When in fact, if we just lowered taxes by 5%, I think we'd all be okay. But that being said, especially when it comes to the high net worth individuals and high income earners, tax is a big thing. Maybe you could talk a little bit about that and how it can be addressed and some of the things that you can do.
Yeah. So, if we look at the most recent, and this is sort of back to the debt ceiling, but then forward to taxes, if we look at the growth of Canada's deficit and debts through COVID and the US added about $10 billion to their pile of debt through COVID. Canada added hundreds of billions of dollars. And really, that's got to be paid at some point. Canada is not a reserve currency, so people do expect to have the bills paid. Yeah. So, it's certainly something to be concerned with. I touched on higher taxes in the U.S. Where you might see a bit of a surprise in taxation is you might see the capital gains rate, the inclusion rate, move a little higher. And that's where it would be slightly populist to point at the rich. And that's, the savers, people who have got some money in a taxable account, who have got some outside money, and say, well, we're going to start to tax the rich. And the way you can do that most easily is to increase the capital gains inclusion rate if you're looking to get a segment of the population. And, that's a concern of mine going forward, because it's such an easy and would be ultimately popular grab, on that sort of the middle and growing affluent class. You need to be mindful of taxes, right? That's what you eat. So if you have that opportunity to take some gains and losses and pair those things off now, might be a good way. Taxes never tend to go down over time. So you would expect the capital gains inclusion rate to move from its current level of 50% to 2/3, 75%, somewhere along the way. And it's one of those policies that the government would enact where they would say, well, we're going to tax the rich. But if we look at the truly rich in this country, the Thompsons, the Molsons, the Westons, they don't pay their share of taxes. They have an army of accountants who will move assets here, there, and everywhere in order to avoid any of this, or they simply won't sell.
Right.
And so, there's no need for them to be creating those capital gains events and then paying tax on it. They'll simply sit on their current asset mix. So, I have a little bit of apprehension around where capital gains taxes are going to go. Again, taxes never go lower, and I think it would be a fairly populist move. A lot of people suffered through COVID. There was a lot of hardship that people had. And, I think it would be very easy to say, okay, we're going to tax the rich, and they're going to miss taxing the truly rich, and they're going to hit that segment just under the rich, because those are the people, these are the people who can't afford to spend $5,000 on an accountant to avoid $6,000 in tax. So,
well, yeah, and I don't know again how fair that would be, but this is also why that segment particularly hires financial advisors to at least take advantage of the tax breaks that we do have, and make sure, to your point, are you taking your capital gains? Are you doing your tax loss harvesting? Are you doing the things that are necessary to make sure that you at least minimize your tax, which is your right as a Canadian?
Yeah, and again, this is where advisors really make their bones, right? Getting clients to make their mid-year RSP contributions, getting clients who are married to a particular stock or a fund. That stock or fund, that doesn't love you. Don't love it back, right? This is a commercial transaction that we're making. We want to move from an opportunity that hasn't worked into something that's going to or should. It's a great opportunity on the advisor side to take a look at, everybody will own too many funds. And this is a great opportunity to winnow that list down to something more manageable. People buy books, people transfer in assets. Great opportunity to say to a client, hey, this is a free transfer out and you have a permanent tax asset. So how about we get you on the program? And, advisors can really show the client that they're listening, that they care. We're talking about your taxes, and putting capital losses on the books. Those don't expire until you do, right? So you may as well try and do what you can to maximize that. So that's where I think inflation, or sorry, that's where I think we're looking tax wise, right? I think we're going to see some posturing around the capital gains inclusion rate. I also unfortunately think that people are going to see their overall tax rates on earned income dribble higher, just because that's an unavoidable. You can't get away from it, and so they'll move it up a little bit. But again, they'll be trying to hit the target with the rich, and I think they'll miss the target on who's rich and who's trying to grow.
Right, and who's actually contributing back into the economy.
Yeah.
Well, this was great, Simon. For my little rant, that we've been here before. The news has always been negative. Every year something is coming up, and I've been in this business quite a long time, and I can't remember a single year where there wasn't a crisis. Whether it's a global crisis, whether it's a conflict, whether it's inflation, whether it's tax, whether it's a market or earnings. But over that same period of time, we've created an enormous amount of wealth. We've created great wealth for clients. We've continued to guide them to not make bad decisions at bad times for the wrong reasons. And I think, Simon, you pointed out most of these. So with that, any final words for our audience?
Yeah, we've talked a lot about inflation, and we've talked a lot about taxes and the like, but lost in that conversation is if we go back 30 years with an average inflation rate of 2-ish%, the S&P 500 is up 4 times, right? And so there's the noise, and then there's our action, and we can control our actions. And I think it's helpful sometimes to do a little bit of writing down, a little bit of journaling about how you feel around major events, and then you can go back and say, well, 2011, Greece was going to crash out of the euro. Well, that was the big topic of 2011. Didn't happen. Where are markets from 2011? And you can get a sense of, again, it doesn't repeat, but it sure does rhyme. We've seen a lot of this before. And all we've seen out of that is the compounding nature of equity markets. And, staying invested, staying on course, stay on your plan, and be calm about it, and rebalance, take your taxes, and help your clients get where they want to go. They'll love you for it.
I think it's great advice. So, Simon Bars of IPC Private Wealth, thank you so much for being a guest here again. And I'm sure that we'll bring you back again, because this is a great topic. Everyone really appreciates sort of a perspective of a long-term, somebody who's been in the trenches, who's worked with a lot of the high net worth people. So can't thank you enough. So anyone who wants to talk about your high net worth clients and what your strategy is, happy to have a virtual coffee. With that, thank you very much for joining us, and look forward to the next episode.
Thanks for joining me on Turning the Page. What did you learn from today's episode? If you follow me on LinkedIn, please drop me a comment there. I'd love to chat with you about it over a virtual coffee. Send me a message on LinkedIn, or you can do so at our website. The link's in the show notes. I'm Chris Reynolds, and until next time.